I guess that's where, like you said, the financial analysis of each individual situation comes into play. So at the end of the policy, let's say it's a 5-year policy or 10-year policy, do you then just get to realize the cash benefit, just take that as cash? Or what happens in that event?
So when you're building up the policy and you have cash value, you could use it for whatever you want. Let's say you fast forward, you've paid off the whole policy, you have like $500,000 in cash value already built up in the policy. You could turn it on for retirement income, like I want $10,000 a year for the rest of my life, or you could withdraw larger amounts. You could use it for business purposes. There's no restrictions or like regulations on what you could use that cash for. You could use it for whatever you want in any frequency one. And also you don't have to wait until you're in retirement years to touch that money. You could essentially, year one put cash in and then borrow from a portion from that from year one. So like almost instant liquidity, and the liquidity is guaranteed too. You never have to qualify for the loan. Like you never have to go through underwriting for the loan. The insurance company will always give you up to 90% of your available cash value.
Yeah.
At any time, you just fill out a form, you send it into the insurance company, you ask them they ask you which account you want to transfer to, and then they deposit it in that account. And then now you have a loan agreement between you and the insurance company, and then you can control the payback period. If you miss a payment, it's not like anything's going to happen, but you want to get into the habit of borrowing and paying back that money within reasonable time.
Yeah. Okay. And in terms of obviously, once I get the policy started and it's running, let's say it's for £100,000. And I'm paying monthly, let's say $1,000 or whatever the premium is. From day one or after a month or so, I haven't fully paid into it, but the cash value that I'm going for is the 100,000. Can I still borrow, let's say 50,000, even though I haven't actually fully paid out my full cash value because I haven't reached to the end?
Yeah, you can never, in the first couple of years, you're not going to be able to borrow more than you put in. You'll probably be able to do that later on in the policy once the cash value grows. But pretty much when you pay for the policy, like the premiums that you put into it, there's going to be like it's called the illustration, and it has a breakdown of the insurance coverage. Like line one, for example, would show you've put in maybe like $10,000 a year. And then from there, a portion of that goes towards the cash value, and then a portion of that goes towards the life insurance. Let's say somebody is 30 years old and they put $10,000 a year in. Line one may show $10,000 going into the policy, and then cash value of maybe $5,000 in year one, and then a death benefit of maybe $600,000 of death benefit in year one, and then every year the cash value and the death benefit keep growing. So you gotta. It's kind of hard to do all this math just like in the air. But in the first couple of years you won't be able to borrow more than what you put in. But eventually, over the years, the policies we set up, the way we structure them, they typically break even around year 3. So after time, the policy, the cash value eventually outpaces what you're putting into the policy.
Yeah. I see. Okay. And do the people who are taking these out, do they have visibility of where the premium of the money is invested in, or is that left to the insurance company itself, I guess? So people can't choose like what funds or what is happening with the money.
Yeah, exactly. Yeah. So the insurance company, they take care of all of that. It's not like an investment account where you could log in and then kind of choose, high risk, moderate, low risk. It's not like that. Insurance companies do all of the investing in the back end, and here's a good thing, is about 60 to 80% of their portfolio is made up in the bond market, and the other 20 to 40% is made up in real estate investments and private loans that they charge interest on. That's those are the ways that insurance companies make money. And if you notice, we didn't mention stock market in there. The insurance companies don't invest in the stock market. They're actually not allowed to, or they're not allowed to invest in any speculative investments, like risky investments, So this means that insurance companies have the highest guarantees when it comes to the return on your money. With all the companies we work with have been paying dividends for over 160 years. We only work with 4 insurance companies that have been paying dividends for over 160 years. Now, although dividends are not guaranteed, we only work with companies that have been paying out these dividends, and they're not correlated or connected to the markets. So they've been paying dividends even during the Great Depression, even during the 2008 market crash, and even right now with all of the uncertainty in the stock market due to the pandemic, they're still paying dividends to the policyholders.
Yeah. Wow. Thanks for that. And in terms of obviously, when people are looking to invest and getting these policies, there's a number of concerns. One could be the returns that they will get given certain economic situations that happen in the world. I mean, the example is this pandemic, for example. So how are you seeing the returns that the insurance companies are making? I mean, you mentioned there that they invest in real estate and sovereigns or bonds. So have you seen much shift in the returns that they are making, which are impacting both either the cash values or the I guess the death benefits are probably guaranteed, but also probably the premiums. Are they getting to ask for higher premiums for the same? How is the pandemic and its impact in the whole global economic environment impacting the industry at the moment?
Yeah, really good question. Surprisingly, Alex, it hasn't affected that much. For example, the rates are still relatively the same. The cash values for people's accounts haven't been reduced. They're still earning interest on those accounts. The death benefits haven't been reduced or are affected by the conditions. The only thing that I've noticed so far that's changed is they are a little bit more strict on people. Like, for example, if you have had COVID, you would have to wait like 30 days to get the policy effective. And if you are, it's depending on the company, over the age of 70, you would have to wait like 6 months to get approved. Those are so some slight medical underwriting, but financially speaking, I haven't seen really any changes financially. I haven't seen any accounts decrease. I haven't seen more premiums required for the same insurance. That's all stable, except for the medical underwriting part. That's been a little bit tightened up, of course, because of the pandemic.
Yeah. Okay, cool. That's great. Thanks for that. And how about just talk us through some of the tax benefits as well of these policies? That's quite a key element as well of the bank on yourself, I imagine.
Yeah, absolutely. Yeah. So, I'm not a tax professional, so seek a tax professional when it comes to this. But pretty much the cash value of the policy, when it grows every year, when it's earning compound interest and dividends every year, it's growing tax deferred, meaning you don't have to claim those on your taxes. You don't have to, if the insurance company, if you have $100,000 in cash value in year 5, and then year 6 you have $110,000 in cash value, you don't have to pay taxes on that increase in cash value like you do with other investments. So that's one huge tax advantage there. And the other tax advantage in most situations, because you're funding the policy with after-tax dollars, and they go into the policy, when you take that money out, you're taking that money out as either a loan or a return of premium, which are both tax-free in the situation. And this doesn't work in every situation. Sometimes the money you take out is taxable, and that would be called a modified endowment contract, meaning that the policy now is a taxable vehicle. Similar to other investments, it's now taxable. But in most situations, we try to avoid the MEC or the modified endowment contract. So we structure it so that way, you're making money, paying taxes on that money. It goes into the policy, it grows tax deferred, and then when you take the money out, you're taking the money out tax free, even if there are gains. And there will be over time. Your money will multiply over time. It's very it's normal to see somebody fund a policy for 20 years, putting in $500 a month, and then we project in 20 years later they'll be able to take out $1,500 a month. So pretty much for every dollar put in, they can take out 3 times that tax free. And then of course the last tax benefit is the actual life insurance part, the death benefit. In the US and Canada, that is income tax free. So it's a very efficient way to pass on general wealth to the next generation, or multi-generational wealth.
Yeah. Wow, that's great. That's great. And how about I think you briefly touched upon the medical conditions or pre-existing conditions. Presumably there is like a health assessments attached to getting these policies? Yeah.
And in most situations, there's a full medical underwriting part or exam that's necessary. In some situations, like the insurance companies, they have like algorithms where if you're within a certain age, they could do accelerated underwriting where it's only like a week of just them doing their research, no exam is needed, and then you can get approved. Those are a little bit harder and it's a little bit more rare. But overall, for these policies, you'll need medical underwriting, and it's kind of hard to judge like which conditions, because the insurance companies, they'll never just say like if you have this, then you cannot get approved. They'll want to know like the severity of it, how long, what are some of the conditions or cures. So it's a full medical underwriting part. It takes about 4 to 6 weeks to do on average.
Okay.
Yeah.
Yeah.
The good thing though is we can always, go through the whole process. So the clients can reach out for a free consultation. They could do the financial analysis for free. They could do the personalized solution for free. We could submit the application for free and then wait, 4 to 6 weeks. And then after the policy is approved and the rates are approved, then we can start funding the policy. So it's almost like no risk to see if this will actually help you financially.
Okay, cool. Just another couple of questions now. How in terms of how people actually go about it, in terms of the number of insurance companies that you work with, do people, because obviously you are behind it, the full extent of the number of companies that you work with. So do the people get to choose which company, or you recommend one depending on their financial situation? How does that process work? Because I take it there's quite a number of insurance companies in the background.
Yeah, awesome question. Yeah, so what we'll do is we'll choose the company, we'll recommend it based off of our financial situation, off of our financial recommendations. Like for example, some companies are very good with the single premium whole life policies. Actually, it's only one company that we could do the single premium whole life policy now. So if it makes financial sense for the client to do the single premium whole life policy, the one-time payment, then we could only choose one company. We can't go with the other 3 companies. Now, if somebody wanted to, for example, they were 20 years old or in their 20s and they wanted to fund the policy for as long as possible, then we would choose a special company for that. Now, let's say somebody was 55 and they wanted to fund it for 10 years, then we would choose a company for that. So we kind of like know how to maneuver and find the most applicable product and company for somebody's financial situation. Because they're all different. They're different products, different funding limits, different restrictions, so it all comes down to the financial analysis. And then from the financial analysis, we can say, this company would be the best with this amount funded this way.
Yeah, cool. And I guess once the premium is determined at the start, along the period of the policy, there won't be any changes in the premium. Is that correct?
Yeah. So there's pretty much a couple ways to build up the policy. When we're talking about the infinite banking concept or the bank on yourself concept, we're not just referring to general whole life insurance. That's all the same. We're referring to a special type of whole life insurance that's specifically designed for high early cash value. So what that means is, for every dollar you put into the policy, the premium dollars, a portion of that goes towards the base life insurance, the actual life insurance, and then a portion of that goes towards the cash value rider or the cash value part of the policy. As mentioned earlier, we could see sometimes we'll see like a 50-50 split where like half of every dollar goes into the policy, goes towards the base life insurance, the actual life insurance, and then the other half goes towards building up the cash value. Now, typically speaking, the base life insurance, that's pretty much set. If you agree to do, 20 years of $500 per month towards the base, then that is set. Now you can add extra on top of the base that goes directly into the cash value part. So let's say you say, all right, I want to do $500 towards the base and then $700 a month towards the cash value rider. The $700 per month, that is flexible throughout all 20 years. So that can go up and down for all 20 years. But as long as you're meeting the $500 per month, in this situation for 20 years, you'll be fine. You can always go back and add more in. If you add more than the allowable limits from the insurance company, then it becomes a modified endowment contract. So if you're doing $500 per month towards the actual life insurance, and then you want to add like $2,000 a month in, you'll probably mech the policy. You'll make it into a modified endowment contract, and then now it'll become taxable. So,
okay. And the taxable bit in that situation, is it the extra that you're adding, or the whole thing now becomes a taxable vehicle?
now you start to get taxed. So when you're putting the money in, what happens is the insurance company is going to use that to invest. And then when you have gains and profits in your policy, then that becomes taxable.
Yeah.
You could still have tax-free gains in the policy, but it has to be structured properly, and you have to follow the MEC rules, the modified endowment contract rules. You have to follow those, and this is what we do when we enroll somebody into a policy and we structure for them. We do 6-month reviews to see where they're at financially, if they want to add more, if they have more room to add more money in, and if not, it's not always a bad thing, Alex. We can always go back and we can do another policy. You know what I mean? So a lot of people, it's very common for them to get the hang of this and then start doing, one new policy every year. So that way they'll have, 10 or 15 policies, all fully funded, all guaranteed growth, cash growth, all not affected by the stock market, and guaranteed liquidity too. So if they need the money, they can go to themselves and they can borrow from the insurance company at 5% simple interest, a much lower interest rate than a lot of other lenders. You can go to the insurance company and then your money still grows even when you're borrowing the money. So a lot of different strategies. And I would definitely do the financial analysis to see what happens, to see what I can do for you.
Okay. So I take it you just alluded to it there. It's possible for a person to have multiple policies, yeah? As long as you're within that lifetime limit of about 25 multiple of your annual income. Is that correct? Yeah?
Correct. Yes, exactly.